You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Random Thoughts on the Identification of Investment Opportunities, written on 24th of January 1994. Let's dive into the timeless insights that continue to influence investors today. Hey everyone, welcome to today's deep dive, where we're going to be diving into the world of investing with the one and only Howard Marks.
The Marks is, kind of a legend.
Yeah.
Co-founded Oaktree Capital Management, known for his incredible investment savvy.
Right.
And he writes these memos that people in finance practically memorize.
Absolutely.
So we're breaking down one of these memos today.
And trust me, this isn't just for Wall Street gurus.
Right.
This is about understanding how markets work, how to think differently, and maybe even find those hidden investment gems.
Ever feel like you're always chasing the latest trend only to find out everyone else got there first?
Yeah.
Yeah, Marks gets that.
It's a pleasure to be here.
Marks really cuts through the noise.
You're right. His insights apply to so much more than just picking stocks. It's about understanding human behavior, risk, and the very nature of opportunity.
Okay, so let's unpack this.
One of the first things that jumps out from Marks's memo is this idea that there's no guaranteed path to investment success.
It's not as simple as saying real estate always goes up or tech stocks are the future. He uses the example of the Nifty 50 stocks in the 70s, super popular, seemingly invincible companies, but even they tanked when the market shifted.
Exactly. Marks is hammering home the point that context is everything. It's not just what you buy, but when you buy it, and crucially, how much you pay. He even goes as far as saying there are no inherently good or bad investments, only good or bad prices.
So timing is everything.
But how do we as investors wrap our heads around that? Marks dives into this fascinating concept of investing as a popularity contest.
Right, and he illustrates this brilliantly with a Yogi Berra quote, "Nobody goes there anymore, it's too crowded."
I love that. It sounds counterintuitive, but when you think about it, it makes perfect sense.
Think about it like this. By the time an investment becomes the it thing, the price is often already inflated, reflecting all that hype. The real opportunities, according to Marks, are often found where sentiment is low, even negative, where fear or neglect have created what he calls a margin of safety.
So it's about kind of zigging when everyone else is zagging.
Right.
But isn't that a little, risky? How do we know we're not just catching a falling knife, so to speak?
That's where Marx's emphasis on risk assessment comes in.
Yeah, okay.
He's not advocating for reckless speculation.
Right.
He's saying that when fear is high, when everyone's running for the exits, that's when underwriting standards tend to be the most stringent. The market, in a way, does a lot of the risk filtering for you.
But when everyone's feeling invincible, like during those irrational exuberance phases, that's when we need to be extra careful.
Absolutely. Marx quotes Warren Buffett on this, who famously said, "The less care with which others conduct their affairs, the more care with which you should conduct yours." When everyone's piling into the next big thing, that's precisely when you need to ask the tough questions, do your due diligence, and make sure you're not buying into a narrative.
And this is where Marx brings up a fascinating concept.
Yeah.
He talks about Gresham's law applying to investing. Now, most people know Gresham's law in the context of money. Bad money drives out good. But how does that translate to the market?
Well, Marx argues that in investing, it often translates to bad investors drive out good. When the market is flooded with inexperienced or overly optimistic investors, they tend to bid up prices indiscriminately, making it difficult for more disciplined, value-oriented investors to find truly good opportunities at reasonable prices.
So it's almost like these cycles of fear and greed create this self-fulfilling prophecy.
Right.
Fear creates opportunity, but too much greed can lead to irrational exuberance and ultimately a correction.
Precisely. And what's really insightful about Mark's perspective is that he doesn't see these cycles as something to be feared or avoided. He sees them as an inherent part of the market, something to be understood and even leveraged by the discerning investor.
So it's almost like the market itself can be your greatest ally or your worst enemy, depending on how you approach it. But how do we actually put this into practice?
How do we become those discerning investors Marx talks about?
But how do we actually put this into practice? How do we become those discerning investors Marx talks about?
That's the million-dollar question, isn't it? And Marx would argue it's not about having some crystal ball or secret formula. It's about cultivating a certain mindset.
Right.
It's about becoming a student of the market, understanding its rhythms, its moods, and how those moods, those swings between fear and greed, influence not only our own decisions, but the decisions of everyone else.
So it's almost like we need to become market detectives, always looking for clues,
Yeah.
looking for those discrepancies between perception and reality.
Exactly. And that means training ourselves to think critically, to question assumptions, especially when everyone else seems to be buying into the same narrative. Remember what we said about Gresham's law in investing. When exuberance is high, it's easy to get swept up in the crowd. But that's precisely when we need to be the most vigilant, to do our homework, and to remember that price is what you pay, but value is what you get.
So it's not just about being contrarian for the sake of it. It's about understanding value, managing risk, and having the discipline to stick to your principles, even when the market seems to be having a different conversation.
And that's the mark of a true investor, isn't it? Someone who understands that market cycles are inevitable, that fear and greed are part of the equation, and that the greatest opportunities often lie where others are too afraid or too caught up in the moment to see them.
It's like Marx is saying that to truly succeed in the market, you have to be willing to be a little uncomfortable, to think differently, and to embrace that contrarian spirit.
And in a way, that's a very empowering message, because it means that success isn't about having some special privilege or insider information. It's about cultivating a mindset, a way of thinking, that allows you to navigate the market's ups and downs with wisdom and clarity.
This has been an incredible deep dive. Marx's ideas are so timeless and relevant, even decades later. If there's one key takeaway I'm walking away with, it's that investing is as much about understanding human psychology as it is about understanding financial statements.
Absolutely. And understanding that psychology, those often irrational swings between fear and greed, can be the key to unlocking extraordinary opportunities.
It's like that Yogi Berra quote we talked about earlier.
Mm.
Sometimes the best opportunities are hidden in plain sight. In those places, everyone else is deemed too crowded. So for all of you listening, here's the thought to ponder as you navigate your own investment journeys. In a world obsessed with following the herd, how can you cultivate that rare and valuable contrarian spirit? Thanks for joining us on this deep dive. We'll see you next time, ready to explore more fascinating ideas and uncover those hidden gems of knowledge.